So I've been talking to some friends, and they were pretty bullish on Salesforce stock. So what I have here is some analysis that I've done, a scoring system that I've developed, and I want to look at Salesforce in relation to all the other application stocks. Not all of them, but some of the bigger ones in the space. So Salesforce, CRM, they're in the technology sector, and in my scoring valuation system, they're getting a 3.8. Now, the way that this system works is -10 would be the worst company in the world, and +10 would be a very, very good company. Everything's perfect in their numbers. And so CRM, Salesforce, it's above zero, so it's above that 50% mark. It's above the halfway point. But I like to focus on stocks that are five and above. I really like to make sure that these are quality companies. And we can see some of the metrics that I'm using when considering companies. So I'm looking at their PEG ratio, their forward PE, their debt to equity, their return on equity, their return on invested capital, their profit margin, their expected revenue growth, and their expected EPS growth annualized for 5 years. So I take these things into consideration, and what I'm seeing is all Salesforce really has going for it is pretty decent um, forward PE. And I say pretty decent, I mean, that is fantastic. And this is something that we'll come back to in a bit that might be attractive as an investment at this point. But we can see a couple other companies pop up here. As a matter of fact, Adobe and Microsoft are tied for first place. They get a score of 6.2. That goes above my threshold of 5. And so these are stocks that I might consider looking a little bit more into when it comes to their intrinsic value. SAP is up there at 5.6, and then Uber comes in at 5. So just for a real quick analysis and to show you how I do what I do, what I'm going to show you is the scoring method, and I'm going to run some intrinsic value calculations in a bit here to show you, um, even though these are quality companies, they may be priced too high or too low based on what we expect them to do. So um, we can see here that ADP, they have really solid return on equity, return on invested capital. Um, Microsoft has really good profit margins. Oracle has really good expected revenue growth. These are highlighted of in the entire list, in the entire category. We're highlighting the number one and the number two position here. So, for example, Uber has the best PEG ratio of all the companies listed here. SAP and Adobe are tied for second at 1.31. So anyway, this is the scoring method. This is what we come up with the scores: 6.2, 6.2, 5.6, and 5 for these companies. And so what I'm going to do is I'm going to run these through an intrinsic value calculator, including um, Salesforce, and I'm also going to put in Palo Alto Networks as well. So the discounted cash flow model, what's coming up with these? Well, Salesforce actually has the biggest margin of safety according to the discounted cash flow models that I have run for Salesforce. Even the bear case is coming in at 502, and the current sale price for Salesforce is $247. So that's doubling your money there. When we average all three of these together, we get a discounted cash flow intrinsic value of 706. That might be too bullish for some people. Um, that would be too bullish for me. I would look into these numbers a little bit more. I did run these numbers myself, and based on what I saw for expected earnings growth, this is what I'm getting. Bear cases of 502, doubling your money in a bear case. So that's very appealing to me. But again, if we go back to the score, Salesforce is coming in at a 3.8. So this might be something I consider. I'd want a little bit more information. And then Dovey comes in very strong second place with 64% margin of safety. They're currently selling for 329. And then even the base case is a double of that. It's over $600. So that's also something that gives me pause. Maybe we're being a little too optimistic with the revenue and earnings per share growth over time. And so this is just the discounted cash flow model that I've run. And so we look at these together. So the intrinsic value for these companies based on the discounted cash flow is given in this column here. I also run a Graham valuation model, a bear case, a base case, and a bull case. There's the dividend discount model. None of these companies offers a dividend, so I don't look at that. or if they do offer a dividend, it's negligible, so I don't even look at dividend discount models. Here's their current price. And so I average all of these models up and I get their intrinsic value. And so for Adobe and Salesforce, these averages of the discounted cash flow and gram valuation brings these numbers a little bit more down to earth, a little bit more down to reality. But we're seeing margins of safety in the 40% range. So because Salesforce doesn't hit that 5.0 score threshold, this may be something that I'm not going to place too big of my investment, my weekly investment on. Adobe is something that has a strong number. I think it was what, 6.2? Yep, Adobe was 6.2, and it's coming with a margin of safety of 47% based off of these numbers. Again, I may want to run these again just to make sure I didn't do anything too optimistic when it comes to their earnings per share growth or the discount rate in these models. But these are definitely companies that I would consider looking at in the software space. So in the software application sector, rather industry of the technology sector, those would be the two that stand out to me the most. And so my friends that I was talking to that are pretty bullish on Salesforce, they might have an argument when comparing it to similar companies. However, not exactly the strongest. They have fantastic forward price to earnings ratio. So this may be cheap. This may be one of the cheaper valuations that you'll get it at for quite some time. So possible buy. Adobe might be slightly better at this point in time.